After Supermicro announced its first quarter earnings, the stock has fallen like stone. They have missed both on revenue and margins as well. Forward guidance was above expectation, and they also have increased their full year revenue target from 33 to 36 billion. But they have already warned that the margin is going to be 3% lower in the next quarter. On the positive side, this was the first time that Charles Liang put a number on the margin for the data center building block solutions, which was very bullish. So let's see how they did and what they expect for the future. In 2025, they have delivered a revenue of 22 billion, and they have increased their 2026 guidance from 33 to at least $36 billion. This would mean an increase of at least 63% over last year. I think that they will push for over 50 billion in revenue for fiscal 27. They do have the manufacturing capacity in place to deliver up to 100 billion in revenue every year. So I believe that the bottleneck will be the lack of energy, which will slow down the AI build-out. This means that the quarters are going to be very lumpy. Backlog will increase, but they might not be able to fulfill contracts as the shell itself is not going to be ready. Or the shell might be ready, but they can't connect to the grid. A good example of this is CoreWeave. They have announced delays by a third-party data center developer, which hit full-year guidance. As a result, the stock was down, I think, by 16% the following day. At first look, Q1 for Supermicro was a disaster. They have guided for a revenue of between 6 and 7 billion, but they only have delivered $5 billion in revenue. However, you can't look at this without context. The revenue miss was due to delayed revenue recognition. So they now project Q2 revenue to be between 10 and 11 billion. This would be a significant increase over last year. Actually, the largest ever in the company's history. Last year, they have delivered around 5.7 billion in Q2. So if we take the midpoint of the range, then that would mean an 85% revenue increase year over year, which is great. And they have also confirmed that they should deliver similar revenue in the coming quarters as well. I mean 10 billion plus in revenue every quarter. If you add up the numbers and compare it to the full year projection, then they would need to deliver just over 10 billion in both Q3 and Q4 as well. So in Q1, they have delivered 5 billion. For Q2, the midpoint of the guide is 10.5. That would get them to 15.5 billion in the first 6 months. This means that they would need to deliver a bit above 10 billion in both Q3 and Q4 as well to get to the target 36 billion by year end. I believe that their order book is going to be full. The question is when they can get on site and deploy their systems. The problem again is margins, and this is an ongoing challenge. They will take a one-time hit of 3% in the next quarter. In Q1, the margin was 9.5%, so in Q2, this will bring the margins down to around 6.5%. I mean, it is understandable. They are almost doubling their quarterly revenue. To increase revenue from around 5 billion to over 10 takes a lot of heavy lifting. Supply chains, overtime, and so on. Plus, they are working on one of the largest AI factory build-outs in the US. I found it interesting that one of the analysts asked them why they are doing this project if it hurts their margins. And they basically pushed back and partially doing it because of the PR, the visibility, and the additional business it will generate. It's kind of the same as when they have built the XAI supercomputer. That got a lot of hype as well. I would be interested in how many leads that project generated for them. I think that it is similar here as well, because the pricing for these projects is very competitive. I could see Q2 to be the bottom regarding margins and to see a gradual improvement from there on. Data center building blocks should help in the long term to increase their profitability. This was the first time that Charles Liang put a number on the potential margin for DCBBS, because before they only said that it is going to be margin accretive. But now he said that the modular systems should deliver 20% plus margins, which could make a significant difference over time. DCBBS is almost zero of their revenue now, but they said that it should gradually improve and could reach 20 to 30% by the end of 2026. That could help to lift their margins back to a healthy level. They were also working on other interesting projects which they didn't mention. For example, they were working on South Africa's first AI factory. Interesting that in most articles only Altron and Nvidia was mentioned, but not Supermicro. Following the Q1 results, some of the analysts adjusted their price target on the stock. Two of them have increased their price target, while the others cut their target mainly due to concerns about margins. It is all about the margins. For example, Argus Research upgraded the stock from hold to buy with a $64 price target. They believe that they have got punished enough in the last couple of months for the low margins. They have also highlighted that there are significant tailwinds ahead in the AI build-out. By the way, this is the highest price target among the analysts that have recently updated their target. KGI Securities increased their target from $36 to $60. This was the biggest change in price target among the analysts. Then you have Rosenblatt. They have lowered their price target from 60 to 55, basically on the same margin concerns. But they expect these cost pressures to ease over the next 2 quarters as the Blackwell platform transitions to mainstream production. Despite the near-term margin challenges, Rosenblatt kept its buy rating. Then, on the other end, you have Goldman Sachs. They have the lowest price target of $30 and they have kept their sell rating. If Supermicro can deliver $36 billion in revenue in 2026 and get its margins on an upward trajectory, then it could be an interesting play. Hopefully, margins are bottoming out this quarter at around 6.5% and start increasing from there. Data center building blocks with their projected margin of 20% plus should help to achieve those higher margins. If you want to invest in the stock, make sure to dollar cost average. This will help you to smooth out the fluctuations in the share price. And in any case, make sure you do your own due diligence. Thanks for watching and see you in the next one. Thank you. Bye.